have some silver. Well, not physical silver. I have Sprott physical trust silver, easy silver for me to own, which I bought because I thought that silver was underpriced and was going to pop. Well, my reason to own it has taken place. The stuff goes from $25 to 70, $80. And I look at my thesis and I looked at why I owned it. Well, why I owned it has occurred. You need to discipline yourself to sell when the circumstance that caused you to buy something has occurred, and not be greedy and hold on to the very last smidgen. And I am likely very soon, I haven't done it yet, but I'm likely very soon to sell the silver that I bought in anticipation of just this event.
Rick Rule has long emphasized that commodities should be approached with intent, discipline, and clearly defined objectives. His analysis of the current silver market reflects that philosophy. While he remains constructive on the long-term outlook for precious metals, he is equally clear that markets do not move in straight lines. Silver's recent performance, in his view, suggests that some of the tension that had built up over years of undervaluation has now been released. That does not negate the bull market, but it does shift the conversation toward timing, selectivity, and risk management. Crucially, Rule also extends this framework beyond the metal itself and into the equities tied to it. Silver miners and related stocks tend to act as leading indicators late in a cycle, often flashing signals that physical prices alone do not. Understanding when equities begin to diverge, lag, or accelerate can provide insight into how far along the bull market truly is. This distinction matters because the most meaningful gains are often captured not by chasing strength, but by recognizing where value still exists before it becomes obvious. Beyond precious metals, Rick Rule also broadens the discussion to energy markets and geopolitics, particularly the renewed tensions surrounding global oil supply. From U.S. foreign policy maneuvers to pressure points in energy-rich regions, he frames these developments not as isolated events, but as part of a wider struggle over strategic resources. We will unpack how these dynamics intersect with inflation, commodities, and capital flows in just a moment, so make sure to stay with us, subscribe if you haven't already, and turn on notifications so you don't miss any part of this discussion. We appreciate your support and hope you enjoy the video.
Gold and silver, and to a lesser extent copper, were coiled springs. Copper, by the way, and we'll talk about this later, is still a coiled spring. I don't expect the manic performance of 2025 to be repeated because the tension that was on the spring, so to speak, has been released. A move in gold from 2,000 to 4,000 removes a bunch of the undervaluation. I believe over the next 10 years, gold will go up, and we can talk about that later, and it'll grow up substantially. But I don't think we're going to see 100% compound moves in gold. I must say, when I was reviewing 2025, New Year's Eve this year, I sort of have a meeting with myself every year. And at least materially, I looked back on 2025 with some fondness and some awe. And make no mistake, I expect that 2026 is going to be a good year for natural resource investors. But to the extent that their expectations are set on a repeat of 2025, I think they're going to be woefully disappointed.
And what are you making of silver currently?
Depends on which buyers you're talking about. For the very large buyers, like my former employer, Sprott, where I'm still the largest shareholder, when they need to buy lots of silver for the Sprott physical trusts, they can buy it. When retail people try to buy 1 ounce bars or 10 ounce bars through retail channels, they have a very difficult time. And there is structural disruption in the traditional silver markets, in particular in the COMEX, which is a paper market. That market was structurally over-leveraged. Some days, the market traded contracts that were equal to 200 times the amount of silver available for good delivery. It didn't matter for 50 years because the silver didn't deliver. The paper contracts settled in paper. They were rolled over. What happened just very, very, very recently is the LBMA and European markets found themselves structurally short of silver. And the spot price for silver was 4 or 5% higher in London than it was in New York or Chicago. So people started taking delivery because they could make 4 or 5% overnight. Simultaneously in the U.S., the lease rates for silver. Many people don't know that there's a lease market for silver for jewelers and industrial users, fabricators. The lease rates went from 3.5% or 4% to 40% because the people who had been holding silver for lease, myself included, at the end of the lease term, which are very short term, sent the silver to London to make 4% overnight. These are disruptions that are temporary in nature. The disruption that's less temporary in nature, I think, is the coming multipolarity in silver markets. Silver used to be controlled in London and in the U.S., New York and Chicago. It's estimated now that 25% of the physical silver that trades in Dubai. That's a big, big, big change. And a bunch of silver trades in China. China, in addition to being a large silver producer, is the largest refiner in the world. About 65% of the world's refined silver comes out of China, which means that Chinese export sanctions don't just apply to silver produced in China, but rather silver processed in China. And the Chinese apparently have come to believe that silver is, like other materials, as much an industrial and strategic material as it is a monetary metal. Now, you have to read a couple of other things into the Chinese action. They banned silver exports from China, except for companies that were licensed by the Chinese state, which is to say their friends and relatives. They've licensed 44 companies to export silver, which is, the sort of rent speaking that you might expect when 10,000 people rule 1.4 billion people. But nonetheless, that will, I think, continue to disrupt the silver market. I also might mention that outside of the monetary realm, where I'm more conversant, silver delivers a lot of utility in fabrication processes. My good friend Frank Giustra quoted a source suggesting that there's no demand elasticity in silver use for solar up to $135 an ounce, which is to say the reflective properties of silver and the ease with which it is used to coat solar panels means that no significant substitution and no significant fabrication changes will come into the market unless the silver price goes above $130 an ounce, $135 an ounce. So it's important to note that the utility of silver in applications like germicides, water treatment, and solar means that there's a lot of structural inelasticity around demand at what are frankly sharply higher prices.
Do you think even at $80 we will see limited additional supply? You would reckon that at least some people are incentivized to produce more?
You will see some increase in primary silver production. That will happen. But primary silver production last year was about 18% of total supply, well after recycling and byproduct production. I think that looking out over 5 years, the increase in the copper price will have a lot more to do with increased silver production than the increase in the silver price. If we were ever to see, again, a good market for lead or zinc, there's a lot of silver produced as a byproduct of lead and zinc deposits. Increases in copper, lead, and zinc production would have more of an impact on the supply side with regards to silver than increases in the silver price, paradoxically. Where the increase in the silver price really comes into play, and I remember this in the 1990s, a fairly large amount of physical silver is held outside the market in India. And if you have increases in the dollar quote in silver, combined with a decrease in the rupiah quote in US dollars, you get a parabolic move in silver in India. It's held as a store of wealth by poor people. Back when you were a very, very young man, I dare say a boy, Warren Buffett owned 15-20% of the world's above ground stocks of silver. When the market found that out, the market doubled and then, went up another 50%. And all of a sudden the market crashed. The Indian rupiah fell by 50% against the US dollar. And the silver price was up well over 100% in US dollar terms. So silver in Indian terms, in rupiah terms, was up by 400%. And that corresponded to, and I forget what it was, either a drought or a flood, but a bad harvest for the Indian peasantry. And they had the choice between keeping their silver, which was up 400%, or feeding their families. Pretty easy choice.
Building on his earlier remarks, Rule frames gold and silver as markets that were deeply coiled before their breakout. The repricing that followed, particularly in gold, has removed a significant portion of that embedded undervaluation. While he remains constructive over a multi-year horizon, he is careful to temper expectations for repeat performances of the magnitude seen previously. Commodity bull markets tend to evolve in phases, and the transition from explosive upside to more selective gains is often where inexperienced investors become frustrated while seasoned capital begins repositioning. Silver's case is further complicated by structural factors within the physical market. Rule highlights persistent dislocations between paper pricing mechanisms and real-world availability, particularly as delivery pressures expose the limits of leverage embedded in traditional exchanges. At the same time, silver's growing industrial importance introduces a layer of demand inelasticity that is rarely appreciated by the market. These forces do not guarantee uninterrupted upside, but they do suggest that any period of consolidation is occurring against a backdrop of tightening fundamentals rather than weakening ones.
Rick, with silver going as parabolic as it has been going in recent times, how are you looking at the metal currently? Is it time to, offload and take some profits, or do you think it is still an interesting hold?
I think it depends on who you are and how long you've owned your silver. Whenever I buy anything, I write myself a memo, page and a half long memo that says why I'm doing it, what could go right, what could go wrong, what time frames am I looking at, what price expectations do I have, and what will I do if something goes wrong. I have some silver. Well, not physical silver. I have Sprott physical trust silver, easy silver for me to own, which I bought because I thought that silver was underpriced and was going to pop. Well, my reason to own it has taken place. The stuff goes from $25 to $70, $80. And I look at my thesis and I looked at why I owned it. Well, why I owned it has occurred. You need to discipline yourself to sell when the circumstance that caused you to buy something has occurred, and not be greedy and hold on to the very last smidgen. Make no mistake, I save in gold. I maintain liquidity in US dollars, and I speculated in silver. And I am likely very soon, I haven't done it yet, but I'm likely very soon to sell the silver that I bought in anticipation of just this event.
I believe earlier in the interview you mentioned that you view copper as a coiled spring. Of course, it's currently trading very close to all-time highs. Are you viewing copper as a when question? When will it go up, or is it an if question?
When, again, in the near term, some of the tension on that spring has been released.
Yep.
But copper has a long way to go. Again, this is a metal where the utility of copper relative to the price is extraordinarily high. What people like you and I, wealthy Caucasian people in Western countries, think about is AI and Teslas and little Apple products and stuff like that. They forget that there's still 1 billion people on Earth with no access to primary electricity. And we're going to solve that problem in the next 20 years. We've done a wonderful job in the last 40, raising the material standard of living of the poorest of the poor. A spectacular job. Hats off in particular the Chinese for urbanizing 500 million people. Spectacular job. We're going to finish the job in the next 20 years. It's going to require a lot of copper. But it isn't just a demand story. We have underinvested in copper as a species, as an industry, for 30 years. We've underinvested in exploration. We've underinvested in construction, production. We've overinvested in regulation and delay and tax and royalty. And there's no way in the world in the next 5 years that we can make up for 30 years of underinvestment. We can't do it. And when we invest, here's an example. In the U.S., there's a wonderful undeveloped copper deposit called Resolution. I've been there. It's spectacular. Grade 1.5% copper. Median mine grade worldwide, 0.4. So this is 3 times the average grade worldwide. Over 1 billion tons. It's got a great location. It's between a couple of copper mines. Nice place for a copper mine, right? Highway going across it, rail going across it, water, power. A couple of towns nearby full of copper miners. Couldn't get better than that. And the thing has been in permitting for 28 years. So depending on where you find it, even if you find a good copper deposit, by the way, you have to go look for it. You have to drill it out. Then you have to permit it. The average time from the indicated discovery of an economic deposit to production, according to the industry, now exceeds 15 years. So let's say for fun that we could go out and find a bunch of good deposits in the next 5 years. Of course, we have to look for it. It won't impact supply for a long time. And the other thing that happens, if I'm right about the real rate of inflation, is that the cost of building the physical infrastructure to mine copper is going to go up very, very, very fast. So what is today a $5 billion bill around a porphyry new build in the Andes, in 2026 becomes a $6 billion build, and then a $7 billion build, and then an $8 billion build. In an era where the long-term interest rate is going up, despite the fact that the short-term interest rate is going down. So the capital budgets increase at the same time that the cost of capital increases, and importantly, at the same time that government theft, royalties, uncompensated offsite improvements, taxes increase. This is an if, not a when. People don't understand the value of incumbent, built, permitted, long-lived producing assets.
Your thesis is well understood, Rick. Incredibly interesting. What are some of the best names to start researching in the copper sector?
I think you start at the top. For people who have the courage, and it takes courage because there's political risk, I think you look at Glencore. They're really good in the coal business. They're really good in the copper business. They are, I would suggest, the smartest of the major miners. But there's political risk. There's a lot of emerging markets assets, and there are a lot of assets that there are allegations were acquired by means that are no longer legal in the United States. I'm not smart enough to tell you if that's true. I think you look at the merger between Teck and Anglo, where some of the Anglo shareholders are selling off because they were looking to be taken over by BHP, and some of the Teck shareholders are selling off because they were looking to be taken over by BHP. In other words, there was a disappointment around the merger. So I think you look at a circumstance like that where you have a pretty good range of assets and where you have the ability, I don't know if they do it, but you have the ability to reduce G&A substantially. There's two sets of management teams there. You need to make one. So I think that's a good name. I'll make my friend in Peru very angry with the next thing I say, but I think you look at a little stock, if you want to, called Amerigo. It's up by 200%, and he thought it was funny that I made it a top pick. If you look at Amerigo's production profile, they've got at least 30 years of reserves left. They don't have to permit the mine. It's built. The stock is up by 200%, but I would argue at today's net present value, the value of the company is up by more than the share price is up. Now, you have to have the courage to buy a marginal producer here. It's embarrassing to me, actually, to mention Amerigo in the same breath as I mention Glencore. But it's an important teaching tool, much as we talked about earlier. Agnico Eagle's net present value at today's gold price being higher relative to the share price than it was 1.5 years ago when the share price was half as high. People don't understand the juxtaposition between the price and the value of something, and it's important to understand the whole equation.
One of the most important distinctions Rick Rule makes is between speculation and savings. Silver, in his framework, occupies a different role from gold. Gold remains the anchor, the long-term monetary asset held for preservation of purchasing power, while silver functions as a higher volatility expression of monetary stress and industrial demand. When silver performs as expected and fulfills the thesis under which it was purchased, discipline becomes essential. Markets reward patience on the way up, but they punish complacency when investors refuse to reassess their original assumptions. This discipline is especially critical when examining historical precedents. Silver has a long record of sharp advances followed by violent corrections, often driven not by changes in fundamentals, but by liquidity shocks, currency movements, or forced selling in key regions. These episodes do not invalidate the secular bull market. Instead, they serve as reminders that silver's path is rarely smooth. Understanding where the market sits within that historical rhythm helps investors distinguish between temporary exhaustion and genuine trend reversals. Equally important is the role of mining equities, which often behave differently from the underlying metal as cycles mature. Late-stage bull markets can see divergence between price appreciation and equity performance, driven by cost inflation, political risk, and capital discipline. Conversely, periods of consolidation in the metal can coincide with improving fundamentals for well-positioned producers whose valuations fail to reflect future cash flows. Beyond precious metals, Rule's broader commodity outlook underscores a deeper issue facing global markets: chronic underinvestment in essential resources. Whether in metals or energy, years of regulatory friction, capital misallocation, and geopolitical interference have constrained supply growth. In the case of oil, geopolitical tensions and regime change narratives often obscure the underlying reality that energy security remains a central pillar of economic stability. These pressures do not resolve quickly, and they continue to feed into inflation dynamics that ultimately support real assets. Taken together, the message is not one of caution for its own sake, but of strategic positioning. The precious metals bull market is not ending. It is evolving. Periods of rest, consolidation, and reassessment are not obstacles but opportunities for investors who understand the cycle and respect risk. Silver's recent run has validated long-held arguments about undervaluation, but the next phase will reward those who remain disciplined, informed, and selective. If you found this breakdown helpful and want deeper, data-driven analysis on precious metals, commodities, and macro trends, make sure to like the video, subscribe to the channel, and share it with others who take markets seriously. Thank you for watching, and I'll see you in the next one.